Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. This week has certainly gone very quickly. We're almost at another weekend. This week we have of course been focused a lot on the protests from last weekend, the outbreak situation and zero COVID, and we neglected the economy. For a large part of today's episode, let's rectify that and catch up on several very important economic and financial updates. Spoiler alert, the economy is still not looking too good, and indeed the recent public discontent, including the small-scale protests we have seen, could to some degree be a social manifestation of underlying economic pain. This week, the National Bureau of Statistics published the official PMI. The manufacturing gauge for the month of November slowed to 48 from 49.6 in October, while growth in the new order sub-index fell to 46.4 from 48.1. The new export order sub-index also eased to 46.7 from 47.6, all indicating intensified downward pressures. Of course, we know the primary cause of the slowdown. These are COVID-related restrictions. Quote, "The official PMIs add further evidence of another large blow to services activities as virus disruptions intensified last month. The hit to industry looks to have been more modest, but downside risks continue to grow as the virus situation continues to worsen and will weigh heavily on the economy into 2023. End quote. Goldman Sachs, in a research note, expressed this week, quote, "The deterioration of manufacturing activity was mainly linked to protracted COVID restrictions and weak demand in both domestic and external markets." End quote. This is the official data. We also have the Caixin China General Manufacturing Purchasing Managers Index, PMI, which tries to give a more independent snapshot of the country's manufacturing sector. According to the Caixin Index, China's PMI rose to 49.4 in November from 49.2 the previous month, still remaining below 50, that is in contraction now for 4 months in a row. Wang Zhe, a senior economist at Caixin Insight Group, repeated the same position as the previously mentioned economists and analysts. Quote, "COVID outbreaks have been spreading across China since October, and their impact on the economy has grown more and more obvious." End quote. Now, with all this in mind, this makes our coverage yesterday of a potential pivot for China vis-a-vis zero COVID just that much more important. As we can see here, it is the consensus of these analysts that zero COVID restrictions are one of the biggest factors pulling down economic dynamism. The report, that is the Caixin report, shows that costs of production rose in November on the rising prices of bulk commodities such as metals and crude oil, but, quote, "manufacturers had a hard time passing on costs to their consumers because demand was already weak." End quote. Weak demand has been a recurring theme for the Chinese economy this year. Also of concern, surveyed companies cut jobs at the quickest rate since February 2020, when China was battling the first wave of the pandemic with nationwide lockdowns. Next up for the economy, China's housing sales slump persisted in November. According to data from China Real Estate Information Corp, new home sales of the 100 biggest real estate developers dropped over 25% year-on-year to just shy of 560 billion RMB, about $80 billion in November. This is following a 28% decline in October. Meanwhile, Chinese financial media outlet Yicai reports that regulators forecast that 2022 property sector sales will drop a total of 44% over 2021 levels, from 18 trillion RMB, approximately $2.5 billion, to a range of 10 to 13 trillion RMB. Data from the China Index Academy shows that of the local governments of the 22 cities that they follow, land use rights auctioned as of the end of November reached just 55% of the annual sales goals of these municipalities, a huge hit to fiscal revenue. The biggest drops in land use sales were seen in Liaoning, Jilin and Tianjin, the major port city to the north. In Liaoning, land sales collapsed over 70%. While Beijing has done a lot in the past few weeks to reduce the risk of more debt problems with developers, especially on the supply side, they have done very little to improve consumer confidence on the demand side. We remember that authorities are trying to address a debt crisis among developers by boosting financing on three fronts: stock sales, bond issuance, and bank loans. Regulators issued a 16-point plan earlier last month to spur the real estate market, while several state-owned lenders pledged at least 1.3 trillion RMB, $180 billion in funding for builders. Officials have also lifted a ban on local stock offerings by developers and widened a program allowing them to issue state-guaranteed bonds. These developments we have all covered in previous episodes, and developers this week are already taking advantage of some of these new measures. For example, Shimao Group Limited announced this week that it intends to raise funds for offering shares to as many as 35 selected investors. The funds will be used to, quote, ensure delivery of projects under construction, repay part of its debt principal and interest, and replenish working capital according to regulatory requirements. End quote. And this week we have seen yet more supply-side reforms and easing measures. For example, as of yesterday, Thursday, China's joint stock banks and smaller city commercial lenders have now handed out more than 2.2 trillion RMB, $310 billion of credit lines to property developers. More than 30 developers, including top players such as China Vanke Co. Limited, Long4 Properties Co. Limited, Media Real Estate Group, and Country Garden, have received credit lines offered by the banks. Now, putting aside the very real concerns of one, that the demand side remains very weak, and in a market, of course, it takes two to tango, and two, that the wider systemic issues surrounding debt, bubbles, and resource misallocation remain, there are still concerns surrounding these supply-side easing measures. The additional funds being provided to developers are primarily for delivering projects that have been pre-sold to home buyers. S&P Global Ratings estimated in September that $112 billion is needed, quote, to ensure distressed developers can finish pre-sold houses. End quote. But with the stalling economy, this number will likely rise. So these bailouts, though in the hundreds of billions of dollars, will mostly be sucked up by the need to finish existing projects, not expand new activity, let alone pay back bondholders, especially foreign ones. Now, we have one more important economic development to cover. Guys, if you enjoyed today's episode, don't forget to hit that like button, and as always, anyone who wants to help support the channel, help me keep this channel sustainable and primarily subscriber supported, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much everybody for the ongoing support. Now, despite all this poor economic news, China's stocks had a spectacular week, capping a great November for the market. In November, the Hang Seng China Enterprises Index jumped 29%, its best for any month since late 2003. The benchmark Hang Seng Index surged almost 27%, the most since 1998. US-listed Chinese stocks are also having a great month, with the Nasdaq Golden Dragon Index up 30% in November, a dramatic turnaround from October's 25% plunge. The CSI 300 index of mainland shares gained nearly 10% in November. With the economy in such a bad place, why are we seeing this? Well, the market had already priced in a very pessimistic outlook. So, with analysts betting that China's protests, which we have recently seen, and public frustrations would push for a faster reopening, and other signs of reopening before that, investors poured back into stocks. And because these were already at very low base levels, November saw a huge jump relative to October. And of course, the relatively strong performance in North American markets also had a flow-on effect. This market sentiment is clear, as we can see that the best performers have been stocks for companies which will mostly benefit from reopening, including airlines, casinos, and restaurant operators. In yesterday's video, we discussed in detail the signs that suggest that perhaps Beijing is indeed pivoting on its zero-COVID policy, potentially signaling an accelerated timetable for reopening. We will find out in the coming weeks and months whether these investors' bets are on the money or recklessly premature. Okay, that is today's episode of China Update. Thank you so much everybody for watching. I will see you all tomorrow.